Welcome, everybody. Just to begin, I'll run through the objectives that we're hoping to cover off today. So this workshop has really been designed to give an early stage view on capital raising. So I'll talk through the possible sources of early stage capital, and I'll try to emphasize where I can throughout that what is different specifically to HealthTech. I'll talk through a little bit about how COVID has changed the landscape, although that's probably, things have moved on a little bit from now. So I will talk a little bit about COVID, but then I'll also talk about the current economic climate and how that's impacting capital raising, particularly in our sector. The elements of an effective capital raise and when to develop your capital raising strategy, and some other things to think about, which including how to value your business, term sheets, what they are and what to be aware of, and governance. So it's quite a lot to cover off. We'll probably take about an hour and a half to get through everything. Quite a lot to cover off. So yeah, like I said, this is very much the fundamentals. And I will also mention towards the end some of the other workshops that Callahan has coming up, which dive into some of these areas in a lot more detail. So this is really here just to set the scene for everybody. Before moving on to the workshop, I do want to note a couple of things. This workshop is designed to focus on capital raising for HealthTech and look at some of the nuances and differences when raising capital specifically for HealthTech companies. And this workshop is focused on equity financing. So when you're looking to raise capital or to get money into a company, you could go down the debt financing route, which is when you borrow money, whereas equity financing is when you sell a portion of equity in your business in exchange for investment. And just so everyone knows, the key differences between that: debt allows you to retain ownership and control. It's usually cheaper and a quicker process for raising capital, but the drawbacks of that, you can't raise as much. Sometimes you can't raise anything at all, especially for early stage companies. And of course, with debt funding, you have to pay it back eventually, which can, in a sort of a high-tech company, can hinder your growth and is also risky if you have unpredictable cash flows. So we're focusing on equity capital raising. And do have to mention that last bullet point, that this subject is governed by the Financial Markets Authority Act. So in no way is this workshop giving any particular advice, but we're just providing information about the elements of capital raising and some fish hooks to be aware of along the way. So yeah, please do feel free to ask questions in the chat. I'll try to keep my eye on the chat box as we go, but Jamie might interrupt as well to ask some of those questions if I miss them along the way. Okay, so to begin, I'll rattle through this quite quickly. This is the sources of capital raising. So starting right at the beginning, friends and family. This is a route that often very early stage companies will rely on, either your own money, friends, or family to get started. They're sometimes referred to as friends, family, and fools because they're people that believe in you. They'll back you because of that, and not necessarily because they're doing any sort of due diligence checks on your technology. So some people, and this is kind of, it's been known as friends, family, and fools for a long time. People are now starting to call it friends, family, and fans, because fans of you and fans of what you're trying to achieve. As I said, these are the people that fund you at a very early stage, or they're the investors of the last resort when nobody else will put any money in. You might be able to go to sort of your immediate connections. Obviously, the pros of this form of raising capital can be informal. It can be easier to convince someone to come on board since they know you as a person and they believe in you. But the drawbacks from this type of money is that it's often not what we call smart money, in that it's not money invested by financial professionals or people that really understand the sector, and they can't necessarily provide expertise and intelligence that other forms of capital raising can. And of course, if you're raising money from family members, it can become uncomfortable at times like Christmas when people are wondering what's going on with our investment, why have we not got our money back yet, those kinds of things. So then the next form of capital that you might turn to when you're very early stage are angel investors. And angel investors vary. They can be either individuals that might be high net worth individuals, or angel groups. So there's collections of angels that are networks throughout the country. So for example, a few of them are up there. There are about 15 angel groups in New Zealand, and they provide seed funding and sort of early stage funding. The pros of angel investing or angel investors is that they're very active. They tend to be really interested in sort of providing time and knowledge to the sectors that they're interested in. They're easy to access. That's why they're part of angel networks, because they like the networking that comes with that, and they like learning about new technologies. And they, as I mentioned, they usually come with a little bit of domain expertise and the networks that are often so essential to growing a high-tech or a health tech business. The cons, and we'll hear a little bit more about this soon, but the cons are that their valuations, especially in New Zealand, can be quite conservative. So most companies that are raising their first formal round of equity funding in New Zealand with angel investors tend to land on a valuation of something around $1.5 million. That just kind of happens to be where most angel investors will value a company that is early stage. A couple of things I wanted to mention about angel investors. There's lots of networks, there's lots of individual angels in New Zealand, so be prepared to hear no more often than you hear yes. It can take a lot of time to find the right angel that believes in your business and believes in you and wants to take it forward. Yeah, seek out the most appropriate investors. And it can be hard to find the right angel to approach, but the angel network that exists, they can help with that. I would say that the first round typically takes longer than subsequent rounds, just in terms of bringing people up to speed with your technology. Once you have an angel kind of hooked, then you're in their network, and often follow-on funding can be a lot easier. One thing I would mention is it's never too early to be talking to angels about what you're doing. As I mentioned, they're often people that have made a lot of money and they want to give back and contribute. So even if they're not interested in investing, they may have advice for you, or they may be able to sort of set you up for conversations later down the track. So if you can find yourself talking to an angel or talking to the networks, they're often great people just to chat to in terms of advancing your business. And yeah, as I mentioned, one of the best things about angel networks is their networks. They have great networks, and they tend to be people that they've made money, and they sort of feel like they're not going to make a lot of money by keeping their money in the bank, and they often find property investment, which is so commonplace in New Zealand, too boring for them. So they find angel investment exciting, and they want to help Kiwi entrepreneurs grow exciting innovation. So that's angel investors. We will come back to angel investors in a little bit. But crowdfunding platforms, I did want to mention crowdfunding platforms. They've become quite commonplace over the last sort of 5 years. And there is a difference between crowdfunding and equity funding through these crowdfunding platforms. So crowdfunding usually involves people giving money in exchange for a reward, which might be an early prototype of a product, or they're just giving money as a donation. Whereas crowd equity funding is a capital raise. And it was enabled by legislation several years ago, but it is capped at a $2 million raise, because you can't take large sums of money from unsophisticated investors that don't maybe know where they're putting their money. So it tends to mostly be suited to products and ideas that are sort of meet a broad range of people's needs, or tap into their desires to help out communities. So it's very difficult to raise crowdfunding for very niche ideas. But some of these organizations that are doing crowdfunding, Snowball Effect and Pledge Me, you might have heard of. They're sort of best because they are capped at the sort of $2 million level. They're good for seed funding and for sort of smaller established companies. The pros, it can be low cost, quite quick and quite easy to raise funding. It also, if you have a product that's sort of for a good cause, it can help raise publicity. And it saves time, because you don't need to approach investors one by one. And you don't tend to give up control of the company so much. You don't have to give up a board position. And you might create some advocates out there in the community that have invested in your business and sort of are almost ambassadors for for what you're doing. But the cons are that you can't guarantee that it's going to be successful, and it's a very public way to raise capital. You usually have a threshold that you've got to meet before your fundraiser is successful, and so it's very public. If you don't meet that threshold, sort of everyone's aware of the fact that you tried to raise funding and the community didn't see the value in it. You also are raising money typically from unsophisticated shareholders, so they're not necessarily providing much besides a bit of cash into the company, and you also end up with a lot of shareholders, which that the crowdfunding platforms help with the communications with a large number of shareholders, but it doesn't stop shareholders sort of wanting to talk to you when you're anywhere about their tiny investment that they might have in your business. Okay, and then venture capital. So this is a major source of funding for a lot of people in the health tech sector. There's a lot of venture capital firms that have emerged in New Zealand, but some of the big ones, Movac, Punakaiki, Brandon Capital, and they tend to all focus on sort of different sectors and subsectors. So these ones that I've pulled out are all sort of technology investors, but for example, Movac tends to target tech companies, and they most of these companies prefer to invest in businesses that have demonstrated that they can draw on revenue. So they're not so good for very, very early stage companies, although, as I mentioned, that depends on a sort of a case-by-case basis. Some of these venture capital firms like Brandon Capital, for example, invests in the life sciences from biotech through to medtech. And if there's a technology there that they see a lot of value in, it might be pre-revenue by a long way, but they may see merits in investing in that. The pros of dealing with venture capital firms is that they have significant funding to invest, and they typically understand the tech sector because, as I mentioned, they will focus on sort of niche areas. But the cons, most of them, and this isn't exclusive, but most won't consider pre-revenue startups. And the pool of funding in venture capital in New Zealand is small by international standards. Although that has grown considerably. And I would say this is one of the things that throughout the COVID period, this kind of the venture capital scene in New Zealand expanded considerably. So even going back just sort of 3 years, it was much smaller than it is now. And I think that's for a variety of reasons. But one of the if you think back to COVID, there was a lot of cash floating around looking for a home, and so there were quite a few VC firms that were established. So a couple of the new ones that have turned up in New Zealand, Bridgewest Ventures, Nuance Connected Capital, which invests in deep tech, including biotech and medtech, and there's quite a few others. The one thing I would say is that at the moment the economic climate is a little bit uncertain, and so I think whenever that situation arises with venture capital firms, they tend to hold back a little bit on new investments, and they keep a little bit of their money aside for the businesses that they've already invested in, just in case they might need follow-on investment and the economic climate doesn't allow capital raising for them. So probably at the moment is a little bit more challenging to raise funding through venture capital firms. But as I mentioned, there is still a lot of activity in New Zealand. There's a lot of firms looking for places to put money. So I think it's still very much a good source of revenue for the health tech sector. And I did want to mention, because this is a session targeted at health tech companies, I wanted to mention global corporate. So these are the big companies, like whether they're in medtech and consumer health or in the pharmaceutical sector. So these are firms like Medtronic, Johnson & Johnson, Procter & Gamble, GSK. Most of these firms, and this is a lot of the work that I do at BioPacific, is engaging with these types of firms. Most of them prefer late stage investing. So they prefer to invest in a technology once it's had some proven success on the market. But all of these firms have kind of their niche areas that they want to stay on top of. And so for really exceptional technology or for ideas, they will look earlier and they will invest in that sort of, those sorts of ideas before they've demonstrated their success in the market. Obviously, the pros with a global corporate is they bring massive amounts of investment. They have infrastructure already bedded in, global networks. They have access into different markets, different routes, know-how, massive marketing groups. Those are sort of the obvious pros of dealing with global corporates. But the cons are that they can be very time-consuming. It takes a long time to get in front of them, to get them on board. And of course, it limits options potentially for the future. So if you do a deal with one large corporate, it kind of excludes you, in most cases, from dealing with others in the future, which may or may not be a bad thing. It kind of depends, but something to be aware of. It is really interesting. I spend a lot of time talking to global corporates, and especially for those of you that are involved in sort of digital technology, there's a lot of the big medtech companies that did traditional devices, and they're starting to sort of move into that digital tech space. So and actually, it's not just those classic medtech players that are doing that, but we're also seeing the likes of Amazon, Google, Samsung, Apple, all looking to enter the space. And what's really interesting about it is if you talk to, like the Johnson & Johnsons of the world, they're used to devices and sort of physical things. And they're not quite sure at the moment how the business models and, how revenue is going to be produced from some of these new digital technologies. They're still trying to work that through, but they are really interested in it. And they're aware of the massive competition that's coming on board from some of those tech players like Apple, for example, which, their watches now have built-in heart monitors and things like that. So so they are very aware of that and very interested in technology that is out there that they should look to capture at an earlier stage. To talk to these global corporates, you typically would go to one of these large conferences. So the photo on the left I took at sort of one of the large Europe medtech conferences. The photo on the right is from the big bio conference, which is held annually in the US. And those corridors of tiny meeting rooms just go on and on and on. There's hundreds of them, and you sort of can spend the whole time rushing from 15-minute meeting to 15-minute meeting. But they are a really useful way to get in front of people, and often these businesses are happy to meet you just to talk through your technology. I'm just going to open the chat here just to check. I didn't have that open. Okay, it looks like no questions. Okay, great. This slide here I was showing through the COVID years just to say that the conversations with global corporates moved online, made it actually a lot easier for companies in New Zealand to get in front of these businesses. But I think things have kind of moved back now. There's been a couple of years now of the big kind of networking sessions happening in the US. But interestingly, they are still retaining sort of this online segment. So I think while it's valuable to be there in person, if you are early stage and you're really cash conscious, at the moment, there is still an opportunity to meet with some of these organizations. You just have to be aware of the massive time difference that comes with dealing with them from New Zealand, which is always a nuisance. So just to kind of summarize what we've talked about just in the last few minutes, this is sort of the area of investment that those different pools of capital come in, or this was what you saw in the past. This is sort of where they're at today. So you'll see that large corporates, which I mentioned last, they are now sort of investing right across the spectrum of technologies, from R&D right through to those that are on the market. We haven't touched on private equity, but private equity tends to favor businesses that are already either on the market and growing, or very close to being on the market. We didn't talk about family offices, but we do have a few of those in New Zealand. So those are private companies that handle the investment management for wealthy families, families that might have already made money from the likes of a good investment in Xero or Trade Me, for example, and they have the goal of growing and transferring wealth across generations. So they can be, depending on the area of interest, there are some family offices in New Zealand that can be a source of capital. Venture capital, if you compare those two graphs, venture capital has very much moved further down the development phase. And angel investment has broadened to kind of fill that gap. So their angel investors are investing later and later. Venture capital is also pushing later as well. And family and friends, typically always very early stage. Question through about how this graph is aligned with digital tech. I think it's probably fairly it's fairly consistent if you sort of ignore the phase 1, phase 2, phase 3 there at the bottom. I think angel investors, very much early stage, when you're sort of in development, that's where they would be most interested and most able to invest with the pools of money that they have. Venture capital with digital tech, it depends, because often digital technology doesn't require the same level of investment as drug development, of course, which can take up to $1 billion to take a drug right through to market. And medtech takes typically less money than that. But yeah, digital tech can be a lot quicker to market. So angel investment can be a really good source of capital, and can, in some situations, take a digital tech company right through to market, to revenue generation. And similar with things like crowdfunding platforms, they can be a source of capital for firms that don't require so much investment. But for those digital tech companies that do require that, there are VC firms that are investing in digital tech quite actively as well. One area that we haven't discussed today is IPO, or listing on the stock exchange. And that's not typically a route for capital raising for early stage companies. There was, for those that have been around in New Zealand for a long time, there was a lot of IPOs in New Zealand in the health tech space in the very, very early 2000s. And that hasn't necessarily gone so well for those companies, because of course health tech takes a long time until your investors are going to see anything back from their investment. It's also very expensive to list on the stock exchange and gives you a whole lot of other complications, including ongoing reporting requirements. So this, I probably covered off some of the points here, but yeah, different sectors have different challenges when raising capital. As I said, drug development can cost $1 billion and take 10 years, whereas medical devices maybe 5 to 7 years, and digital tech can be anything from 1 year up. So it really depends. If founder raise versus a professional raise, you can either raise funding yourself, or you can bring in professionals that can help you to raise the funding for you. There's obviously fees attached. Usually a proportion of what you raise goes to the founder if you're doing the person raising the money if you're doing a professional raise. But it can sometimes give access to networks that you might not have access to yourself. And it also means often you can continue to work on the business rather than spending all of your time raising capital, which is really time consuming. One other thing I wanted to mention, you don't have to limit yourself to regional players. So we've talked through the local players for VC and for angel investment, but it is a global marketplace, and investors are increasingly looking outside their region to invest. So I think in the past, angel investors would typically keep to their region, and it used to be quite local that they would invest in. But now, often, even in New Zealand, they're syndicating with other angel groups outside of New Zealand to provide access to additional capital. Okay, so that brings us to the very first video. And I will mention that there's, I think there's 7 videos that we have throughout this, and they've been created by Callaghan Innovation so that you don't just have to listen to me talking for the entire time. These videos are quite short. They're about, this is probably the longest one here, and it's about 5 minutes long, but the others are sort of more like 3 minutes. So for this, where I can remember, I'm going to turn off my camera just to hopefully make the video not lag. Let me know in the chat if for some reason the sound's not coming through or anything.
When you're going into raising your first round of investment as a business, you need to think about the capital strategy that will play out over the next 3 to 5 years. Key points you need to think about is only take investment from people you know you can work with. The second key point is to think about the valuation of the business very carefully, not just now, but how it will play out over the next 3 rounds of fundraising. Make sure that your founders have enough skin in the game after the next 3-4 raises, that they are still motivated to do the work to get the business to exit. The mistake we see founders making is that they think about raising capital in terms of just this round of capital, this first round or this follow-on round. And I can't stress how important it is that you think beyond the first round and on to how this is going to play out. Because in these early stage investments, the investors are looking for something different from when they invest money in shares on the stock exchange or invest money in a company that's going to pay dividends in the future. What the early stage investors in the startup sector are looking for is a company that can use this investment to really accelerate their growth to the point that the payback becomes multiples of the investment rather than just gives a percentage return each year. And so what we look for is investors will tell you you kind of need a 10x exit. And essentially what they're saying is, what's the plan for me to get my money out multiplied if I put money in now? And so at the very least, when you're raising your first round, you need to plan out what your capital strategy is going to be, because it's very unusual for a company that is growing fast and does have global potential to actually only need one round of investment. And that's important because you should think about it in terms of how much equity you're keeping in the founder pool. That is for the people who are actually going to do all the hard yards to make the company fly. It doesn't matter, in essence, whether you retain control or not. In fact, with early stage investment, you pretty much give up control as soon as you take on your first investor dollar. But the important thing is that if you plan out through 2 or 3 or maybe more, depending on what sector you're in, capital raises along the way, say over the next 5 years, how much equity are you going to have left at the end of that in the founder pool? Are we still going to have someone in the company who is massively motivated to do the 80-hour weeks that might be required at that point to actually make this company a true global success? The counter to that is companies that we see that don't think about their capital planning along the way and end up with maybe founders who are diluted down to 5 or 10% of the business by the time they've done a Series B or a Series C. And at that point, the investment becomes less attractive because, as I say, we don't have someone in the business who's truly motivated to make it fly. And when I look at a first round investment, I always look for that plan of what's the capital plan, and if we got to 5 years down the track and the plan had played out, which of course it never does play out as you expect, but let's, for example, say the plan plays out, you've done a pre-Series A round and a big 15 million Series A round 5 years down the track. At that point, how much would you have to sell the business for me to get 10 times the money I put in the first round?
Okay, so just turn back on my video. I won't pause on those bullet points at the end, the summary bullet points, because I think if you want to rewatch this later on, then you can, and you'll have access to this video and to these. All of these videos, I should mention, are available on the HealthTech Activator website as well. So if there are any of these that in particular you'd like to rewatch, you can do it that way. I did want to pick up on one thing that Deborah said, and I should have introduced Deborah. She's a bit of a legend in the angel investment space. She's very well connected and very knowledgeable on this area, so that's why she's definitely the subject matter expert when it comes to capital raising at very early stages. But I did want to touch on one thing. She said that investors say that they need a 10 times investment, and I think this is good to think about in terms of this is what these investors, these professional investors, are looking for in general, but it doesn't mean that they will always expect that. They know that when they make investments, that some of their investments will give them absolutely nothing. They might lose their money. They know that some of their investments might return sort of 100 times what they put in. But sort of on average, they hope that that this is the sort of return that they will get ultimately once they exit an investment. Couple of things here, just in terms of capital strategy. A clear roadmap is really important, particularly in the health tech space. So things like having an understanding of the regulatory or perhaps the clinical pathway of your product and how it fits into your plan. These are the kinds of things that investors will typically want to know that you've thought through. And for an early stage company, it might not necessarily be a comprehensive plan. You might not have a full understanding of things like how it might necessarily fit into the healthcare system or how it's reimbursed. But it's important to understand where you're headed as an early stage company and be able to demonstrate that you understand that there is a regulatory pathway that you are going to have to look at. And this is often the case for, it's certainly the case for drug development, medtech. Most of the time it's required for digital tech as well, and it depends on what market you're going into. So just having an understanding of those things are really important. Investors will ask about it, and if you don't understand those kinds of things, they might think that you're too naive to invest in. The reimbursement strategy, those are very, very complicated, particularly in the United States. But again, useful to know about whether it's needed or if it's not needed. If you plan to generate revenue through other means, and that's good to know about as well, because you'll likely be asked that. In terms of raising capital, I want to run through a couple of the obvious kind of costs, just to kind of get that sort of thinking in your mind. But obviously, in order to raise capital, you usually need to have some marketing material at a website, which can range wildly in cost. You might need to go to an international conference, especially if you're speaking with global corporates or international investors. So that can sort of cost up to sort of $30,000, especially with the cost of airfares at the moment. Finding a target list of appropriate investors, most of the time this sort of just really takes time. And also Callahan Innovation does have some access to some tools that can help with this. And so Jamie will mention this towards the end, but that can be an option as well. And then, of course, once you sort of are down the track of raising capital, you do need to fork out for some legal and professional fees, which again can be in sort of in the tens of thousands of dollars. So those things are useful to be aware of. I mentioned earlier that you can go down the professional fundraising route, and usually when you do that, the fundraiser will expect sort of something like 5 to 6% of the raise as a fee. But often that will bring down the cost of some other things, for example, because you are not having to spend necessarily all your own time necessarily out there fundraising, which is hugely time consuming and also distracting. So so that's often why a company will go down a professional raise route. Okay, the next video is presented by Mark Clare, who is a well-known investor, and he has a very casual way of talking about some common capital raising mistakes, which I think are really useful to be aware of. So we'll watch that one now.
Capital raising covers both debt and equity. Today, we're going to be looking at the mistakes that people make in equity capital raising. The first mistake that we see is not understanding what investors are looking for. Investors are looking to make a financial return on their investment, and companies need to understand this going into the process. The simple answer to understanding whether your company or opportunity is interesting to investors is the opportunity big enough? Where if you are successful, the financial returns will be substantial for all those parties involved. The second mistake we see is not effectively presenting the capital raising opportunity to investors. You need to have nailed down your narrative, the story behind the company. You also need to have your financial and operating metrics well organised. Don't get too caught up in capital raising projections. The only thing you can guarantee about those capital raising projections are they'll be wrong. The capital raising projections are there to show that you understand the total addressable market, you understand your unit economics, and you understand your growth story. 3, not approaching investors in the right way. Investors want to see opportunities, but they want to see the right ones. Show them that you understand their requirements and your opportunity matches what they are looking for. Investors also see a lot of opportunities. So first impressions count, and they can last. In a capital raising process, you need to be persistent, but you also need to maintain a tight deadline. In the capital raising markets, we have a saying, capital raisings are like fish, they go off. Fourth, making mistakes in deal negotiation. In negotiating with investors, deal terms are very important and you should get proper legal advice. We have a saying around capital raising negotiations, you set the price, I'll set the terms. The terms are that important. All entrepreneurs are focused on the final price or valuation where external capital comes in. But be careful. Choosing the right investor with good quality terms is more important than the final price.
Yeah, I always like that video from Mark. You can tell he's been in the industry for a long time because he's got a saying for just about every aspect of capital raising. But a couple of things that I did want to sort of reiterate and bring it back to HealthTech. Don't focus too much on the technology. I think technology is obviously really important. That's what people are investing in. But you need to really sell a compelling story of the business and yourself, because that's often what investors are really looking for. A good bit of technology is kind of the first check mark, but they want to see those other things as well, that you're really passionate about what you're doing and that you're the right person to take that technology through to market. Think about who you're talking to. Consider what they're looking for. We've already talked a little bit about how to seek out and find the right investor, but now you've got them in front of you and you're presenting to them. So think through before you meet them, what is it that they're looking for? What have they invested in the past? And that information is usually very easily available. You can find out what people have invested in on the company's register, for example, but also if they are a VC firm, then they'll often have information on their past investments on their website. So you can sort of see the types of investments that they are interested in, and it might help you with your framing of your pitch to them. There is no substitute for preparation. I think it's an obvious one, but you really want to practice your pitch. Remember that these investors see people pitching to them all the time, so you really need to. The bar is quite high. You need to be quite clear in your communications, and don't overcomplicate your pitch. Simplify your message right down to tell the story, and then let the investor engage with you and ask the questions that they want to ask. Okay, so we've talked about the investors and how to find them, but now the pitch is actually really valuable. And Nayo is another great investor. She's now her role has changed since she created this video. She's founded one of those new venture capital firms that emerged during COVID. So she is a real expert, having seen pitches for years and years. So she knows what the good and the bad pitches are. So she's got some good advice in this video, which we'll play now.
Your pitch deck is your opportunity to take the investor on a journey of discovery. At the end of your pitch, your investor should understand why what you're doing is important, what it is that you're doing, and how you're going to execute it. And most importantly, they should feel your passion for the project. The very first part of your pitch is to explain the problem that you are solving. Explain it with passion, explain it with stories, explain it in detail. There's a famous VC in the US that says if you have 95 minutes to pitch, 90 minutes should be your story of the problem. Maybe that's a bit of an exaggeration, but you need to develop the story in a way that emotionally engages your investor. Once you've established the problem, you need to determine who owns the problem. This is critical because if the person who owns the problem isn't the same as the person who pays for the solution, then your go-to-market strategy is going to be fairly complicated. So understanding who owns the problem is essential for the investor to feel engaged with the process. Then you can tell the investor what your solution is and explain your solution in a single sentence and then expand on it. What validation did you do in the market before your solution was created? What changes did you make when you did your market validation to prove that your solution is the right solution for the market? Once you've established your solution, you need to give the investor some confidence in the proof of your solution. What are the statistics on stickiness, customer feedback, testimonials, anything that can prove to the investor that there is product market fit for your solution for real customers? Next, you need to look at the market. Who is your target customer specifically, as much detail as you can give, and then what's the total addressable market that your solution can reach? Once you've identified the market, look at who else is out there. What's the competitor landscape? How is your product unique and different from the other competitors in the space? How high is the barrier to entry for other players coming into the market? And that leads straight into your IP position. Have you protected your trade secrets? Have you filed a patent? What is the price for somebody else to come in and copy, take over, or repeat your product or service in the market? And it's at this point that you need to confirm whether or not you have a freedom to operate in the markets that you're intending to go into. Now you can bring in your financials. What's your financial model? Basically, how are you going to make money, how much money, and when? Too much financial information at this point is not a good idea. You need high-level financials in your pitch and more financial information and a backup of the model in your due diligence kit. Articulate your vision for the company. Where is it going to go? What do you see as the final solution? Is this a company that's going to exit? It's going to be an IPO? It's going to be a trade sale? Or are you going to be a global company that grows and pays dividends? Why you? Why should I, as an investor, trust you to deliver on your vision, to execute on your plan? What is it about you personally that's special, that's different? What have you done? What's your experience that gives me confidence that you are the person to invest in? And the whole way through, investors are looking for people who are self-aware and coachable. If you can demonstrate those values during your presentation, it's a big leap in the right direction.
Okay. Back on. Okay, so yeah, as I mentioned, Nayo is a bit of a legend in her own right in investment. She created one of those VCs, as I mentioned, during COVID, Nuance Capital, which invests in sort of deep tech right across sort of the health tech space, which is, I think, why you know, you can see her interest area in her presentation. A lot of what she talked about is really relevant for the health tech sector. So, for example, often in health tech, the person that's using the technology might not be the same as the person that's paying for it. So that adds sort of a complication to the storytelling of capital raising when you're pitching. So it's really important, as she said, to explain that information about how you're going to ultimately bring in revenue at the end. One thing that she did mention that I always like to pick up on is that she said, if you've got 95 minutes to pitch, 90 minutes should be the story of your problem. And I think she was exaggerating when she said this, because I've never seen a situation where you would have anywhere near 95 minutes to pitch. It's more likely you'd have something like 10 minutes. But I think the point that she's trying to make there is relevant, that you want to explain the story of the problem that you're trying to solve, because that's what captures the attention of the investor. Couple of other things I wanted to mention about pitching. Pitching typically comes in about 3 sizes. So a 30-second pitch, it's that classic elevator pitch. If you're just bumping into someone and they want to get hooked on what it is that you're doing. Then there's sort of a 3 to 5 minute pitch, which often like when you're at those investor meetings where you're meeting lots of people one after the other in 15-minute blocks, you sort of want to talk to them for about 3 to 5 minutes to allow that time for questions. And then a 20-minute pitch, which would be a full presentation, maybe in front of a variety of investors at various investment raising meetings. You want to take investors with you and explain why it is that you're passionate. And I think for health tech, this is even more important than other sectors, because the health tech sector, it's loaded with jargon. There's lots of acronyms, there's lots of numbers. It can feel really cold and impersonal. But at the end of the day, as you've been hearing, investors are really interested in investing in people. So adding in your personality, your emotion, why it is that you're doing what you're doing, is such an important part of the capital raising process. Also important, providing detail on the customer, the competitive landscape, and the size of the total addressable market. Knowing your market cannot be overemphasized. You've got to know it better than the investor. And often the investor knows the market really, really well. So you need to know your niche even better than they do. Often you find times where someone will be pitching and they'll say that our addressable market is everyone with, for example, everyone with cancer, which provides this much opportunity. But you really need to be able to drill in to the niche of what it is that you're doing and realistically explain the portion of the market that you expect to capture. You need to be able to explain your IP position. So if you have patents, what they cover, what jurisdiction they cover. And being able to demonstrate both science and your business capability is important, whether it's from yourself or whether there's others in your team that have it. Could I give an example question through on what Naya expects when she says to explain who owns the problem? Yeah, so what she's saying there is that it's sort of that classic, what I was saying earlier about particularly in health tech, where it's not clear cut. You're not necessarily just selling a product to a person and it's a single transaction. Often in health tech, there's lots of people involved, and the person that's buying might not be the same as the person that's using it. So the person that is using the, let's just say, medical device has the problem in this example, but the person that's buying at a high level, who's buying that device, isn't that person. It's being done through, whether it's through an insurance company or through the hospital. So it's just that differentiation of who needs the product and who pays for it, is what she was explaining there. Also, when it comes to IP, it's really important to know what you shouldn't discuss and what you shouldn't disclose when it comes to perhaps your patents or that might be in development, or trade secrets. But in some ways, it's almost more important to understand what you can say, because I think so often, I've been involved in investor meetings where the innovator is so scared of saying anything at all, or they're not aware of the things that they can disclose, that they almost say nothing. They sort of disclose absolutely nothing, and they insist on a non-disclosure agreement. And I can tell you that most investors at a first meeting, they won't be interested in signing an NDA. So you won't even be able to have a conversation with them if you're not aware of what it is that what you can freely say without disclosing too much. And as Naya mentioned, only high-level financials are required during your pitch. You don't want to overcomplicate things in that sort of first conversation. So you should be able to describe your financial model, how you're going to make money, how much money you might like to make, and by when. But you don't need to drill right down into the detail. You'll probably get asked for that later on in the conversation, but not first up. A couple of the common mistakes that I see quite often, I wanted to mention, and I think I can't stress enough how important it is to spend time sort of crafting and designing your slide deck, and make sure, in particular, that your team slide and your financial slide look really good, really slick, and are very easy to understand, because these are likely to be your most viewed slides. But yeah, you only have a limited amount of time to grab an investor's attention. So you don't want too many slides, you don't want too much information. I think the amount of information that I've got on these slides today in this presentation, probably too much for an investor conversation. You really just want key points on there, maybe some diagrams, and you want to be able to talk to the investor face-to-face, preferably. So yeah, avoid wordy slides, and watch out for inconsistencies. These are the kind of things that people will pick up on and will become distracted by if you've got inconsistencies when you're talking about markets or product or your financial details. Also, don't ignore your competitors or make false comparisons. So often people will sort of say, this is such a novel technology, we don't have any competitors, it's a completely competitive-free landscape. That is never the situation. There are always competitors, even if they're, they might not be doing exactly the same thing as what you're doing, but there are competitors out there. So make sure you can point to who they are. And don't make unrealistic assumptions that are not backable, because that immediately makes investors sort of question everything about what you're telling them. One other thing that I think is worth mentioning is that, I said you only have a small amount of time to grab an investor's attention. I saw a recent Harvard Business School study that had a look at very early stage investment and the investors that looked at the pitch decks. And on average, an investor would look at a successful pitch deck for 3 minutes and 44 seconds, and 12% of those did that using their mobile phone. So I think it just highlights the importance of some of these messages. So don't use too many slides, don't put too many words on the slides, and make sure what you're telling through your slide decks is very clear and very concise. Here is a list of some questions. I'll give you just a second to have a look at a couple of these. And I'm sure just by looking at these, there's some in there that you would struggle to, anyone would struggle to answer. You know, where is there a weak link in your team, for example? But you should be able to prepare to answer questions like these from potential investors after they've looked at your pitch deck. These questions that I've put onto the slide have all come from the New Zealand Angel Association website, which is a great resource for pitching. They've got a lot of templates on there, a lot of best practice examples. And they've got these questions here. So just sort of having a look at those before you have conversations with investors can be very useful, because it allows you to look at things from their perspective, which often when you're working in a business, you don't necessarily think through some of these things. One of the other things when you're pitching that investors will be interested in is or once you've sort of had your successful pitch, they'll look at due diligence. And so I did want to mention that it is really useful to keep a due diligence file updated, because once an investor wants to see your due diligence pack, they typically want to see that quite quickly. So it's helpful, whether it's just a folder on your computer, just to keep copies of some of these basic things, basic organization things, like your registration as a business, your share register, any contracts that you might have, any IP, regulatory documents, details on employees. And another great resource that I do want to point out is the Kendrick Partners website. So Kendrick Partners, a law firm, but they're a great early stage resource for things like a checklist on what you should put in your due diligence pack. They also have freely available things like co-founder agreements, subscription agreements, non-disclosure agreements, share registers, term sheets, all of those things available as a free template to download. So if you don't have these things and you want to sort of start to get things in order, that's a great resource. Okay, the next sort of section of this is on valuation, and valuation is a really, really tricky topic. Callaghan Innovation holds workshops specifically on valuation for businesses, but valuation is one of those conversations that investors like to have very early on in the conversation, to make sure that they're not at completely different levels, and that you don't have unrealistic assumptions about what your business is valued at. So this is a really important video. I'll explain a little bit more after the video some of the methods of valuation.
Valuation and valuing startups is a really spicy topic, and it's not one that you are going to find any definitive answers on, and in a fairly gnarly sense, it really does come down to what your investors are willing to pay. And every investor is different, and every market for startups is a little bit different. So the New Zealand market, we still have a bit of a reputation for our deals being relatively reasonably priced. And you will see all sorts of different methods for valuation, the venture capital method, the Dave Burkus method, Google valuing startup companies, and you'll find all manner of tips and tricks for valuing your company. But it will fundamentally still come down to what investors are willing to pay. And in that sense, right now, right here, and this little spiel that I'm about to give you will date probably within the next 12 months. But in New Zealand, if you are straight out of the chocks and you don't have any customers yet, and you are raising your first round of angel funding, and if you're going straight in at it and you haven't raised a pre-seed or a seed round or any friends and family, most startups are valued between sort of 750,000 to sort of 2 million or so. But what you want to keep in mind, and the most important aspect for me when you're valuing a company, is understanding what your capital strategy is, understanding how much money you're going to need to raise to get your company to a point where somebody might buy you, where that M&A or that trade sale happens. And so for me, that's about making sure that you retain as much equity as you can through to that trade sale point. And ideally, at that point, you will still have 30% equity in your company. And on the Angel Association website, we have a bunch of templates and spreadsheets that you can plug the various figures into to figure out, what impact that has on you, because you may well be part of a co-founding team, in which case there are other dynamics that you need to take into account. But hopefully that gives you a bit of a sense. The market for startups in New Zealand at the moment, if you're right out of the gates, your valuation is going to be somewhere between 750,000 and 1.5 to 2 million.
Okay, and as Sue, who by the way is the head of the Angel Association in New Zealand, but as she said at the start there, her advice will date within 12 months, and that was recorded a couple of years ago, and I've had a couple of conversations with her since then, and I think that valuation figure that she gave has definitely moved upwards a little bit. So probably you're now looking at between 1 and 2 million is where an early stage valuation will typically land in New Zealand if you're very early stage and you haven't raised any capital yet. But as she mentioned, there are a lot of tools that allow you to calculate the value of a startup business. The next slide, I'll give a couple of examples of those. Investors are really interested, not so much in what the valuation is, but that you've paid attention to what you've considered what a valuation could be. And they want to see that a valuation has been built from the bottom up. And so what I mean by that is, you can't just say the sector that we're trying to get into or the segment is worth, it's $1 billion market, and we think that we could get about 10% of that. You need to start with the approach that you're making and really drill into the niche that you're realistically going to be able to capture. So saying 10% of $1 billion market, that's probably not enough sophistication for what an investor would like to see. Valuations in health tech in particular will often be determined by the regulatory pathway, and in particular what's required on that pathway and where you're at currently. So you need to not only be thinking about what the next step is required, but what the whole journey is. So for example, if you require regulatory expertise later down the track, and you'll need to not only factor in pulling in the capital to fund that expertise, but also valuations often shift once you pass those parts of the pathway. So if you can get past a regulatory hurdle, your valuation will significantly increase, because those are the points that are sort of make or break for a lot of businesses in the health tech sector. You can also, when you are looking to value your business, it's really helpful if you can look at other businesses that have raised capital that are sort of adjacent to what the area that you're working on, because that gives confidence that the number that you've come up with is justified. And if you can share comparables with investors, then it shows that you've really done your due diligence on what your business could potentially be valued at and what a good figure for investment is. And again, this is another area that Callaghan Innovation can help. They have a global database that can seek out recent deals that have taken place in your space. So it is actually becoming a lot easier to value a startup than it was before, because of the amount of comparables that are starting to come online that you can look at. I'm not going to dive too deeply into this because, as I said, there are sort of specialist workshops on valuation, but just to give you a couple of examples, discounted cash flow. For that type of valuation, it's based on the projections of your future performance and the value of future earnings. In most health tech sectors, that can be a lot harder to sort of work out because it's so far in the distance often that you're going to draw on significant revenue. So the scorecard method is one that that angel investors use quite often, and that's sort of just based on an average valuation and other criteria. So they look at startups that have been funded in the same sector, that are at the same stage of development, and then they'll consider a few things on top of that, like the capability of your team, the size of your particular opportunity, the competitive landscape. And then another quick way that valuations are often done in the early stage is through the Berkus method. And for that, the investors will look at 4 or 5 elements and allocate a portion of money, say 500,000 to each of them. So there's 5 examples. They might look at the attractiveness of the business and give up to 500,000 for that. And then look at these other things like how good they rate the management team to be and give a valuation on that segment. And then ultimately, using this method, they might come up to a valuation, a maximum of $2.5 million if they're using these 5 examples. But that's just a quick way that they might often in their head look to value a company. And I think it's important to stress that each of these valuations have limitations, and none of them are going to land on a perfect valuation for your business, but they just help give an idea of what your business could be valued at. And then, like I said, those comparables help to back that up. Most of these rely just on judgment calls, but these are the kinds of things that early stage investors will be doing. One of the things I'd like to point out is that valuing your business too highly too early can be problematic later down the track, because then if you miss a milestone, like for example, passing a regulatory hurdle at the particular time that you said you were going to do it, then your next valuation might be below that of a previous round. And that's referred to as a down round and can cause massive problems when it comes to raising additional finance, because you need to explain why suddenly your valuation over time has gone down. Probably a common phrase that that investors will say is that if both sides are unhappy, then you've probably landed at about the right number. Valuation, it's more of an art than a science. But I think, as I say, with the access to comparable deals that Callaghan can help with, it becomes much easier to sort of land on something that you feel confident in. Okay, capitalization tables go hand in hand with capital raising. They're really important. And if you don't have one, but you are an established business, now would be a good time to start thinking about putting one together. It's much easier to start to put it together when you've got a simple business. But this video from Julie just explains the basics of a cap table. So Julie is with what was Simmons Stewart, but that has now become Kendrick Partners, which is the resource that I mentioned, where there are a lot of good templates available.
I'd like to talk to you about capitalisation tables, or cap tables as they are commonly known in the industry. A cap table is simply a list of your existing shareholders, which sets out their names, a bit like your share register, and the number of shares they have, and most importantly, the proportion of the company that they hold, so the percentage shareholding of each shareholder. Now, the importance of the cap table is that you add to the cap table to include the investment of your investors that are coming in on your round, and so that you can see the number of shares that the investor will be issued when they invest their investment amount, and you can see the effect of that investment on the rest of the shareholders. There's a whole set of mathematics that go with determining how many shares an investor is to be issued when they invest their investment amount, and that can be worked out through your cap table. It's really important to get your cap table agreed up front with your investor. You would be surprised at the number of times we get to finalising documents and then questions arise as to the cap table. And of course that's fundamental, because the cap table sets out the number of shares and the price per share, and as I say, the percentage shareholding. So if there's a lack of agreement as to those figures, there can be a fundamental misunderstanding about the commercial details of the deal. It's also important in your cap table to think about whether you want to reflect your employee share option plan if you have one. Usually, very commonly, a cap table is calculated on the basis that it's fully diluted. Fully diluted means taking into account all options or other rights over shares that you have issued. So the key thing to remember about your cap table is that it's simply a spreadsheet which sets out your shareholders, the number of shares and their proportionate shareholdings. It sets out the number of shares and the price per share and the proportionate shareholding of your investor.
Okay, so as we heard there, a cap table at its very simplest form might look something like this. So it lays out who the shareholders are in a business, how many shares they own, and therefore what their ownership percentage is, and how much they paid for those shares. So here's an example, a very, very basic example, but I'll talk through this because I think it helps just explain why a cap table is so useful in the capital raising process. So for example, in this one, you've got three shareholders, shareholder A, B, and C. You can see how many shares that have been allocated for a consideration of $1 per share. So if we focus on shareholder A holds 150 shares. They own 30% of the business. So this business then goes through a capital raising process, and they bring in shareholder D. And you can see here that shareholder D has purchased 50 shares. Okay, and they paid $10 per share for that investment. So they gave $500 for the investment. So what you can see here is that the owners' interest, so the original owners, shareholders A, B, and C, they have been, their percentage of the business has been reduced or diluted as a result of the issue of shares to shareholder D. So shareholder A still holds 150 shares, but now that's 150 of 550 shares. So they now, instead of having 30% of the business, they have 27.3% of the business. And now that we've gone through a capital raise, it's possible to calculate a valuation of the company following the raise. So you can see that shareholder D, they paid $10 per share. There's 550 shares now. So the company is valued at $5,500. And I think what this sets out in its most basic form is that it's really important to think about how your equity will be diluted through the funding journey. Because as a general rule, everyone will see their equity diluted, except for the last shareholder to come in, because they've obviously, there's no one there to dilute what they're chipping in. And questions are often asked about how much of your shareholding you should give away. It kind of really depends on where you're at and what sort of investment you're going for, what kind of investor you're dealing with, and how much money you want to raise. An investor needs to see an appropriate amount, and this will depend on the investor, but they want to remain, they want to be engaged in the business, but they want to make sure often that the founders are still engaged because, you know, as we've heard, investors want to invest in the founder because they believe in them or in the management team because they believe in them. And they don't want them to be disinterested because they've been squeezed out so much. So for VCs, a rule of thumb, they often want to see about a 20% shareholding in the company because that aligns them with the company. It will often get them a board seat and help them to remain with the company throughout the journey as perhaps their shareholding might get diluted. But yeah, I think important to realize that investors are aware that they do need to keep the key people engaged. So they're not trying to squeeze you out completely when they do invest. But just, yeah, so this is kind of where a cap table becomes helpful when you're looking to raise funding and you want to kind of see how everyone's ownership and interests and valuation changes. There's a question about when bringing in a new shareholder, is there a need to get the approval of the majority of the other shareholders? It's really going to depend on the business and agreements that are in place. Not all of the time, is what I would say, especially for the level of investments that we're talking about at the moment. You will often need majority agreement, but not necessarily. That's kind of, yeah, a little complicated. It kind of depends on how the capital has been raised previously. But the one thing I would say is that, a cap table should take into account the rights of all shares that you have issued. If you have an employee share option, it's important that that's also included so that investors can see what the totality of shares that have been promised are. A cap table should be agreed upfront with investors so that they know what they're investing in and what proportion of the business they are going to own. And it should be one of the first things discussed when negotiated, not saved right until the last minute, because that will often be a deal breaker. So learn early on how a cap table works, be comfortable with it when you start negotiating. It's even in a very simple Excel format, it's really useful for scenario planning and planning for different outcomes, so different valuations, different fundraising amounts. It just gives you an idea of what the landscape is, what the playing field is for negotiations. And the other important aspect of a fundraise is, of course, term sheets. And Again, I do kind of apologize that we're rattling through these topics so quickly. It is a lot to cover off, but I think hopefully this is giving you a good foundation of the things that you need to start thinking about. So term sheets, we'll watch this video now.
A key document in the capital raising process is a term sheet. A term sheet outlines the terms on which an investor is willing to make a financial investment in your company. The purpose of a term sheet is to ensure that both the investor and the company are in agreement in principle as to the key terms of the investment before the parties go to the time and expense of negotiating formal documents, such as a subscription agreement or a shareholders agreement. Now, either party can initiate the draft of the term sheet, but there can be some advantage in being the person to present the first draft of the term sheet. And this is because you get to present your view of the transaction, and then it puts the onus on the other party to then justify why the transaction should be done in another way and that their view of the transaction should be adopted. Now, often a sophisticated or habitual investor will have their own template term sheet, and it may contain standard terms. They may insist that you use their template term sheet, and this is because they'll say they only invest on these standard terms. Now, if an investor takes this approach, I recommend just pushing back a little bit, or at least challenging whether those standard terms are required, because they aren't always required, and you need to make sure that the terms are appropriate for your transaction. So 5 things that, as the company raising funds, you'll want to make sure in your term sheet are, firstly, the nature of the investment. So what is it that the investor is going to get for their investment? Most commonly this will be shares, but it could be something different like a convertible note. The next one is the price, or the amount payable for the investment. You need to be very clear on what they're paying you, for example, the price per share, and when they are paying this amount. Are they paying it all up front in one lump sum, or perhaps in tranches over time? The next one is any conditions to the investment. So an important one for actually both parties is to make sure that the investment is conditional on entry into the formal legal documents such as the subscription agreement or the shareholder agreement. You will also need to make sure that it is very clear what terms of the term sheet are binding and what terms are not. Another term that is important to include in your term sheet are any key agreements as to the shareholders agreement. The shareholders agreement will be negotiated at a later stage in time, but it can be helpful to have these discussions now to make sure that you don't lose your investor further down the track because you're at odds on any particular term to go into the shareholders agreement. The investor will also want to include a number of things in the term sheet. So 5 things that the investor may be looking for include milestones. They may ask the company to perform certain tasks or meet certain key indicators by certain dates and insert some sort of consequence for not reaching those. For example, if they are paying their investment in tranches and a certain milestone is not met, the next tranche of investment may not be forthcoming. They may also ask for founder commitments from you. So that is a commitment that you will perhaps stay in your role in the business for a minimum period of time, or that you'll maintain a certain minimum threshold of shareholding to ensure you have some sort of skin in the game. An investor may also ask for reporting obligations, so some sort of periodic report from the company as to perhaps the financial status of the company or where you're at with your product or technology development. An investor may also ask to include a term on employee share schemes, that is, a statement as to whether there will or will not be an employee share scheme and what number of shares will be set aside in the company for employees to take up. So this brings me to my final general comment about term sheets. Generally, they are not binding on the parties. That means one party cannot compel the other party to comply with what it has agreed to do in the document. Some terms will be binding, for example, the boilerplate, the confidentiality clause, but generally they're not. However, having said that, as between the parties, they will probably consider the terms as binding, as the deal being done. And if you try to change the terms of the deal further down the line, this will probably be met with resistance. So I strongly recommend that before you draft your term sheet, and definitely before you sign it, you engage a lawyer to help advise you on what those terms mean and the consequences of them for your company and the documents to be negotiated further down the line. And I say this because I have seen people take the approach that it's not a binding document, doesn't matter, it'll do for now, we can work it out later, just get the investor to sign. And then they've found when they've come to do the formal documents that actually something wasn't quite right, and now they want to change the term, and that's ended up either with the investor walking or with the company ending up with a deal that wasn't quite what they expected.
Okay, so just to summarize that, so a term sheet is sort of a shorthand way of agreeing terms that have been negotiated, and it's signed and it's given to a lawyer to draw up into a sort of more official agreement. And a term sheet is written in common English, so and it's done soon after sitting down at the negotiating table and agreeing on an investment. So a piece of advice that I would give is to get a sort of an experienced, founder-friendly lawyer to help review and negotiate the term sheet, because as we've heard, it's not legally binding, but it is what's given to the lawyer to write up into something that is legally binding. So it's really important to get those details right early on. You can see there the key points that are typically on a term sheet: the amount that's being invested, whether an investor is paying upfront or in tranches, and that's often linked to key performance milestones. So they may want to tranche payments against meeting those requirements. They'll include a valuation, and they'll include investor rights, including the right whether or not the investor has the right to appoint a director in the firm. Also things like they may also have a key point that the founder is required to stay with the business for a minimum amount of time, so that they're not putting money in and then the founder's walking away, and the reason that they invested in the business in the first place has walked out the door. So they'll often include things like that. And yeah, we've made the point that they're not legally binding, but hard to move away from the terms of a term sheet once they're agreed. So a founder-friendly lawyer very early on in that sort of term sheet negotiation is very sort of critical. And one thing that I would recommend is this video that's available on the Callaghan Innovation website. It's a conversation with Julie, and she has on there, sitting around the table, Ben O'Brien, who's an innovator working with Stretch Sense, and he's also got Damon Crowe there, who is from K1W1, which is Sir Stephen Tyndall's early stage investment fund. And they talk through a term sheet, and they have quite a candid discussion, and they debate the common terms that you expect to find. So you get to see these sort of competing perspectives and sort of understand what those might mean as you move through a capital raise. So if you're new to term sheets, this video, it's about an hour long, but it's actually a really good video to watch just for the education of the things to look out for as you're negotiating with an investor. And you can kind of hear the differences between what an investor, what a corporate lawyer, and what a startup CEO are all looking for when they take a look at a term sheet. So really good to, if you want to get on top of term sheets. Great video. The final video for today is another really important point or another important factor that investors look for when they're looking at a business, and to see that it's got credibility and it's got the right people behind it, and that's early stage governance. And so if we were having this meeting face to face, I would ask you all around the table whether or not you have a board in place, and whether or not you have an advisory board in place. I will cover those off in just a second, but Before that, we'll hear from Suze talking about the importance of early stage governance.
I've been in the angel space for about a decade now. I'm Executive Director of the Angel Association New Zealand, but I co-founded Angel HQ in Wellington about 10 years ago. And so I've literally seen dozens and dozens and dozens of people in your position who are starting out looking to raise capital. And governance is a really critical piece of it, because it's fundamentally about getting the team around that you need to be able to kind of give you that kind of direction and guidance as to where you're going to best and most neatly raise value. We've just done a survey recently of founders and asking them what they most got from one of the things that they were most grateful to get from their board and from their investor director, and they have indicated in a number of occasions that it's the emotional support. And that's where a startup or high growth board, a board where you're raising capital, differs perhaps a little from a more conventional corporate. Is that sort of real kind of, and in fact, as a colleague said this morning on a panel I was at, that it is like a marriage. You know, it really is. You're going down this path for the long haul. In a startup space, a board is your kind of, for me, is the entity that gives you the strategic oversight. You'll be in amongst it. You'll be doing the doing. There will be times when you won't be able to see the wood for the trees. A board should be able to give you that. A board is your strategic oversight, is providing you guidance, is your ability to stress test stuff. And I think in the angel space too, we're not so much looking at risk and compliance, we're looking at risk and reward. And so that's always another really important part of governance and a board in this space. And you're looking to have a board, a formal kind of board, perhaps not necessarily when you first raise that very early seed or pre-seed round. So I'm talking anything from sort of 100,000 through to maybe 200-300, perhaps tops 400,000 or 500,000. But beyond that, when you're raising an angel round or you're raising any kind of formal capital, which is, 500K through to, could be anywhere up to sort of 2 or 3 million, but probably it'll be around about 500K to 1.5 million. At that point, you will need to have a board to have credibility and give your investors confidence that you are willing to have other advice and take on that advice. And the governance piece too gives follow-on investors confidence that you understand what it takes to scale, that you're going to need more than just you. Nobody does the stuff alone, and the board is the first kind of formal recognition, one of the first formal bits of recognition that nobody does this alone. And ideally, a board for a startup, a high-growth startup, it won't be any more than at the most 5, and our American colleagues sometimes think we're over-engineering it to have 5, that sometimes New Zealand startups are over-governed, but having 3 is probably okay as well. But it's really getting your first board in place too, is also kind of getting the foundation right and the structure right, so that when you scale fast, you've got people around you who can help you do that. And your board will have a range of different skills on it, primarily around the vertical or the area that your startup is involved in, somebody who's maybe done it before. Other aspects of the board are that you will need someone who is perhaps well-connected, connections, people. Nobody, we often talk about the fact that when you're raising money, it's not really the money that you're raising, it's the people that you're buying, it's the connections that you're buying that's the really critical piece. I think the really important thing is that when you are looking for that board member, that you go 2 or 3 deep, and once you've done that, you'll have a really clear sense of whether or not that person is the right person to be on your board. Don't forget to do that.
Okay, and I think it is a really good point that Suze makes there, just about the importance of the connections that the board brings into the business, because often they have expertise and connections that you don't have, but that you need. So that's sort of, I guess that's alongside the money, that is one of the major advantages of raising funding from sort of people that really understand your business and what it is you're trying to achieve. So yeah, I mean, just to summarize some of the things that Sue said there, a startup board really focuses more on risk and reward for the business, whereas a board for an established business like a large corporate is really focused on risk and compliance. And I can see that someone's asked, and actually I was going to do this anyway, because I always get asked, what did Sue's mean when she said you should always go 2 or 3 deep when you're looking at bringing someone on board? What she means there is she's talking about doing due diligence around the board member. So if you're looking to bring on a board member and they might be unknown to you, go and do your own due diligence. Go and talk to other organizations that they might be on the board of. So talk to the management team of that company and do that in a couple of, and talk to maybe some of their colleagues as well, just to get a good understanding. It's kind of like hiring an employee. I mean, she said early on in that talk that it's like a marriage, a long-term marriage. Board members are going to be with you for a long time. So you really want to make sure you do all the due diligence that you can before you bring them onto the board, because you're not going to be able to easily get them off the board if you're not gelling with them, or you don't necessarily agree with the advice that they're giving you. So yeah, that's what she means. Go 2 or 3 deep, go and talk to people, understand what makes them tick and whether or not they're going to be a good fit for you. So a board allows you to get a good team around you for direction and guidance, and they'll help sort of raise the value of the business. As Sue said, no more than about 3 to 5 members on a board, otherwise things can get quite unwieldy. But you want to make sure you have a good diversity of skills around the area that you're working in. And just remember that the board isn't remote from the Investment Act. Any substantial investor are going to request a board seat, and that might be for themselves, or they might put a trusted expert that they work alongside onto the board that might know your business or your business sector better than they do. As I mentioned before, there's a very big difference between a governance board and an advisory board, but both are quite useful, particularly for startup organizations. So an advisory board works for the management team and for the business, and they usually have deep domain expertise. So whether that's sort of around science or regulatory aspects of the business, they're really valuable to have to provide that sort of advice and input. Whereas a governance board or a board of directors is something that management reports to. And unless people are appointed as directors of the company, then they're not a governance board. So that would be the key difference. Both have a really important place, but they are quite different. So after that whistle-stop tour of experts in the community, that sort of brings us to the wrap-up. And I just really do want to emphasize the point that a capital strategy is really important. And it's important because it helps you plan over the longer term what you're going to need to raise funding to take a business through and to take something to market, but also make sure that you return something at the end to yourself and to other investors. So you need to really think about where you are in your capital raising journey and what your goals are now, but also in the future. Your capital plan will constantly change and adapt depending on how you grow and what your financial models are looking like. But you do want to be trying to plan out your capital rounds over the sort of medium term, so over 3 to 5 years. You don't want to be in a situation where you're constantly raising capital. So I think that's kind of the key point there is you want to make sure you have enough runway to be able to actually grow the business before you go back out to market to raise more funding. So those would be my key points. I'm really happy to take any questions after this recording, but I might just before we get to that point ask Jamie to jump back on because as I mentioned throughout, there are a lot of additional workshops that Callaghan Innovation run. A lot of them dive deeply into some of these areas like the valuation workshop. And so I think if you're at that stage, really, really valuable to have sort of a deep dive into that area. But Jamie, do you want to pop on and talk to the slide?
Yes, yeah, thanks, Tim. I think at this stage I will just stop the recording. Great.